Good day, students. Once again, I will be recording this question 3 out of 96 marks, and 115 minutes is the required time. And it is based, this question, on financial statements. So let me first read the financial statements that I will be responding to in this question. We are required to prepare the general entries or the general journal to record the adjustments above. Then after, we are required to prepare the closing entries. I will not focus on this part of the question. I will only do number A. So let me tick the one that I will do. This one I will be doing it. Number C, prepare the statement of profit or loss and other comprehensive income of Sinamuva Distributors for the year ended 31st of December 2001. So I will do that. Then number D, we are to prepare the statement of changes in equity of Sinamuva Distributors for the year that ends on the 31st of December in the year 2001 again. And the last requirement that I will do for the sake of this video is number E, which is the preparation of the statement of financial position. So all other requirements, I will do them in bits and pieces separate from this main question, because this question was an assignment comprehensive type. So they combined so many topics in this one question. Now I will be doing these three, and it is always very important to respond to the financial statements first if you are required, or if you have a question of this nature where the income statement is given. Remember, the statement of profit or loss, I will normally call it income statement. So my focus is on the three financial statements, and I will be using the general journal to make the adjustments to adjust the three financial statements. And you will see what I mean when I say I will use the adjustments to adjust the financial statements. Now I have made things very simpler by giving you the rough draft of all these financial statements, extracting the information that we have in the trial balance. Now, first of all, we have a trial balance that says the following information relates to Sinamuva Distributors, and we are provided with the pre-adjustment trial balance of Sinamuva Distributors as at 31st of December 2001. And the minute they say pre-adjustment, that means the trial balance was taken into account before the adjustments were taken into account. So now that means all the adjustments that we have at the bottom here, which is the following adjustments, or sometimes this will be called additional information. So that means the adjustments that we have from adjustment 2.1 up until adjustment 2.11, all these adjustments have not yet been taken into account in the financial statements that we have. So now that is why we need to adjust our trial balance, and we'll have to add some of the amounts, deduct some of the amounts based on the adjustments. Now we have a trial balance which is a pre-adjustment trial balance, and we are given this pre-adjustment. After the pre-adjustment, we have the adjustments. Then after, we'll have the post-adjustment trial balance. So now what I've done for you to simplify, or to give you the strategy on how to answer the income statement, and how to answer the statement of changes in equity, and how to answer the statement of financial position. First thing that you must do, write the entire draft of the three statements, everything that is already in the trial balance. And now in this scenario, this is the statement of profit or loss and other comprehensive for the year ended 31st December 2001. Then after, I know that we start with sales, which sometimes can be called the revenue. So either you say sales or revenue, it is not too much of a dilemma for me. Then we say sales, we record the amount of sales. we go to the trial balance. In other terms, we are recording all the income statement items. There is our sales 381790. Now the reason why I open brackets, because in the adjustments I might need to add or subtract something based on the adjustments. So I have taken this into account, the sales amount 381790. Then I look now for another item of income statement. We have the cost of sales, and the cost of sales, it is 165,400 rands. There is 165,400 rands. So I record that. Remember, the reason why I leave this, there might be something to add or subtract in the adjustments or still in the trial balance. Now, as I'm recording, I'll be taking all these amounts into consideration. We have our sales return. That means somebody has returned part of the inventory that was sold. So now we know that sales return will decrease our sales by the amount of 1,200 in this case, because the sales return, it is 1,200, which is decreasing. And please be mindful of the fact that sales are recorded on the credit side of the trial balance, because sales are income and income increase on the credit side. So now the minute we have sales return, that means our sales now are decreasing on the debit side, because we have returned part of the customers have returned part of the inventory that was sold to them. So this will be decreasing our sales. Hence now we have the sales return on the debit side, and on the income statement the amount of sales return is on the debit side by the sign negative, reducing or decreasing our sales. Then now we go to the next item. We have our now other incomes. Let us look for the other items that probably affect our sales and cost of sales. We have a settlement discount that was granted, and the settlement discount that was granted, it is 380. Now remember, a discount is when we decrease our sales. So the 380 of the settlement discount will be decreasing our sales again, because we have given a discount to the customer at the point of settlement. And I do have a video. I will have a video on the explanation of this settlement discount. This is not a cash discount. It is a settlement discount, a discount that is given when the customer comes and settles his account which he previously bought on credit. But I don't want to go in details, because there's a more explanation on when do we take the discount into account. Remember, when it's a cash discount, meaning the customer is buying now and you are giving a discount now, we don't account for that discount, because our sales would have been recorded at the discounted amount. But let me stop there. You'll get more information as I expand on the settlement discount on the video with regard to the settlement discount. Now the 380 will decrease our sales. I just want to look for another item of cost of sales. There we have settlement discount received. Now in this case we have received a discount. Therefore now this will be decreasing the cost of the inventory that we bought, cost of sales, and the amount of the settlement discount that was received by us, it is 650. It is 650. So now this will be decreasing our cost of sales. Remember, the reason why it's cost of sales, because we buy inventory from the supplier at the cost. Now when we sell that inventory, it becomes cost of sales. So now if the supplier gives us a discount, that will be reducing the cost of what we are selling. So now hence a settlement discount received reduces the cost of sales, because it is the cost of what we bought, and now it is still the cost of what we are selling, which is called cost of sales. So a settlement discount received reduces the cost of sales. Then now we will have what is called gross profit. I don't want to draw the line here and close, because there might be some adjustments that are not yet recorded in the trial balance. But we know that sales minus cost of sales, or revenue minus cost of sales, will give us a gross profit. sorry. Then after we have other incomes. We have other income. Sorry, don't know why I'm doing this. Under our other incomes, we look for the, I want you to see all the income that we have and everything that I've done. We have recorded there, recorded here, recorded 1.2, recorded 380, recorded what else? Segment discount received 650 already recorded. Then we have now rent income. There is our rent income 15,600. Rent income 15,000. You open brackets, remember. Why do we open brackets? There might be something to add or subtract from the adjustments. So you draft the skeleton immediately when you see this question. You draft the skeleton and you record everything that is in the trial balance regarding the income statement, and everything that is in the statement of changes in equity regarding that statement from the trial balance. So let's look for another income. We do have interest income on the investment. How much? 5,000 rands. So this is recorded and this is recorded. And we record that interest income as 5,000 because we expect that in the adjustment there must be something to add or to subtract if there will be an adjustment for that. Another one which is an income is credit loss recovered. Now, meaning this is a debtor who was previously a bad debt and he was declared insolvent, and now he came back to pay us. Remember, it's no longer a debtor. So now we acknowledge the receipt of money from the debtor who was previously written off as irrecoverable when he pays back as an income, which is other incomes. So now that will be also another other income of 120 rand. That is where that 120 is coming from. Then after we go to our expenses, you can have a heading here that says expenses, but we list our expenses by names. It's distribution expense, administrative, and other expenses. So that means these expenses are for these three categories. We have our wages, salaries, assessment rates, and licenses. I just want to take all those ones and you see them. We have wages, there the amount of 2,000, salaries, assessment rates, we have licenses, 1,000. Remember, the 380 is for the settlement discount, and we have accounted for that, 1,000. Then we look for the other expenses again. Other expenses that we have, it is vehicle expense, credit loss, and packaging materials. Now we look for those expenses: vehicle expense, credit loss, packaging materials, 3.5, 550, and 4.7. Then another one, it is insurance, 2,250. Let us look, and we also do have water and electricity for 2.1, and telephone expenses 1.4, advertising 2,000. So I copy all these expenses, I paste them as they are. Let us look in the next page: 2,250, 2.1 water and electricity, telephone 1.4, advertising 2,000. So you copy and you paste your expenses as they appear in the trial balance. That's it, straightforward. So that when we do the adjustments, we know that we are done. Then another expense that you must make provision for it, which is normally not in the trial balance, is an expense called depreciation. I'm just want to highlight that the depreciation, because we do have accumulated depreciation, meaning we do have a vehicle, we do have equipment, and these two assets, they do depreciate. Now, because we have this depreciating asset, therefore now we need to make provision for the depreciation in the current year, and you just write depreciation, you open brackets, because we still need to add depreciation for motor vehicles and the other depreciable asset, it's equipment, and also building. But land and building at your level normally will not depreciate, but further on you will be dealing with the depreciation in the advanced level of accounting. So now you create an account called depreciation, knowing that depreciation is likely to be there in the income statement. Then now we have to make provision for another account again. Let us look if we do have a loan or not. Yes, we do have long-term borrowing, but we are not told of anything regarding interest expense. So now let us also make provision for the finance charges. There we do have finance charges, which is interest on the loan. Just open brackets there. You are waiting for the adjustment that will tell you what is happening regarding this account. Then after you have what you call other comprehensive income. Remember, other comprehensive income, it is what we call the revaluation surplus. When the land and building has gained value, or when the property has gained value, that will be what we call revaluation surplus. So that is where this is coming from. Then after we come to the second statement, the statement of changes in equity for the year that ends 31st December. Opening balance of the equity to the capital. Sorry for that. Opening balance of the equity is the capital of how much? 141,700, and the date is specified 1st of January 2001. So we take that, we record it. The other one to be recorded, the total comprehensive. In other words, when we are doing this rough draft, you need to know what goes where. Now remember, the amount here is the amount that comes from the total comprehensive. The amount that we will get here, we transfer it here as it is, and there is a method mark for transferring that amount from the income statement into the statement of changes in equity. Then if there was any additional capital that was contributed by the owner or the members of the business, that will be recorded as a plus. But if there were any drawings that were done, meaning the owner took inventory or the owner took money for personal use, which is called drawings, that will be recorded as negative. Then after we have balance at the end of the year. Then after we go to the statement of financial position. Statement of financial position is as at 31st December 2001. We have what we call assets. Our assets are divided into non-current, and under non-current we have property, plant and equipment. I want to open brackets here. Under property, plant and equipment, I need to record all the assets that I have. I do have my land and building at a cost of 263,240. I did not record here. I wanted to record when I am recording here. 263,240. So now this will be 240 plus another asset, which is a motor vehicle. Remember, motor vehicle is part of non-current assets, 40,000 rands. Remember, non-current assets are the assets that can be converted into cash in a period of more than 12 months. Meaning, or assets that can stay in the business in a period of more than 12 months. Then now we have equipment, and our equipment stays in the business for a very long time. 9,000 is the cost of this equipment, plus 9,000 rands. Now we need to minus the accumulated depreciation for these assets. Why do we deduct them? Because we need to get to the value of these assets at the end of the year, minus 11,200 rands. Let me verify that. 11.2. The last one, it is 1710. The accumulated depreciation on equipment, minus 1710. Minus 1710. Now remember, in the under the accumulated depreciation is an opening balance. See the date, meaning is the depreciation up to the end of last year. That means the depreciation for the current year has not yet been taken into account. But if this was at 31st of December 2001, that will mean that depreciation for the current year has already been recorded. Therefore now, in that case, most of the times there will be a line somewhere there that says depreciation. Therefore now we'll have to just copy the depreciation and we paste it where it's supposed to be recorded. This is done, 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 and this is done. And now we have to go to the fixed deposit, because a fixed deposit is an investment that stays for a period of more than 12 months. So our fixed deposit, it is 50,000 rands. Fixed deposit. Then we go to our current assets. Our current assets, we have inventory, and we do have inventory here, inventory of merchandise, and our inventory is 8,500 rands. Our inventory, it is 8,500 rands. 8.5. There might be another inventory. Under our trade and other receivables, meaning our debtors, we recorded this one. And if you see, I tick everything. We have trade receivables, which is 5,200 rands. 5.2. Then we will look for others. So we have bank, which is our cash in the bank, and bank is 3,100. Bank, it is 3,100. There is another item that relates to cash that is available. Petty cash, the small amounts 100, and cash float, there is 500. The amount that is kept in the cash register roll, so that we can have change in the following day. That is cash float. This is recorded. Remember, all these are our cash in the bank. 100 and 500. Then we say plus 100 plus 500. Now remember, you are busy getting all these marks as you are recording in this manner. Then now we go to our liabilities and equity. There is nothing yet under equity and nothing yet under capital. And under our long-term borrowing, we did have a long-term loan. There was a long-term borrowing from Bean Ltd. 25,000 rands is an amount. 25,000 rands is the amount of the loan that was borrowed. The last one is trade and other payables. Our trade and other payables, we have trade payables, which is our creditors, people whom we bought inventory on credit from, 9,550. 9,550. 9,550. So now this is almost the last part. The only amount that is not yet recorded, it is the provision for credit losses. This is the only amount, allowance for credit losses. That is the amount that we have not recorded after everything has been recorded in our financial statements. And I prefer to leave this idling so that we deal with it later on. Then I'll explain when we reach to the allowance for credit losses. And you can see that all the amounts have been recorded in their respective financial statements. So that means the only thing that I'll come back for when I'm done with the adjustments is only the allowance for credit losses. So I've copied everything and I've pasted everything. Now I can begin answering. And if you look at the time, it is plus minus 20 minutes, 23 minutes. But because I'm explaining, obviously as a student, just copying and you pasting all the answers, it will take you not more than 20 minutes. Then after we are doing the adjustments now, and my approach is that I must record all the adjustments accordingly. And I will be recording all the adjustments separately. And when the adjustment is done, we record it where it's supposed to be recorded. So we will start with adjustment 2.1. Let us go to the adjustments. Now it says in the first adjustment, packaging materials on hand on 31st of December 2001 to be valued at 980 rands. Now this is the inventory that is left at the end of the year. And previously we bought our packaging materials during the year and it was recorded under packaging material expense account. So now this is the material that was bought during the year, or let me say packaging material was bought during the year. Packaging material that was bought during the year. Now we had 4,700 of packaging material. Then we don't know how much material packaging that was used. Let me say packaging used. Packaging used. We don't know how much was used, but we know that the more we use it, then it will reduce what we have. Then after we have packaging left, meaning the packaging that was left at the end of the year. We have packaging that was left at a cost of 980. This is an asset, meaning packaging material that is not used during the year. Now remember, this is very similar to the topic or to the account called stationery. Stationery that is used for administrative purposes. It is exactly treated the same way as packaging materials. So now it's more like there is a stationery left at the end of the year that is not used. Similarly, in this case, it is the packaging material that is left at the end of the year. Material that we use for packaging. So now this becomes an asset. And now if the question is again, if we had 4,700 that was bought during the year and was available to be used for packaging, and the only one that is left is 980, what happened to the rest? The rest was used. So now we need to know how much packaging material was used. Minus 980, this will give us 3,720. 3,720. This is the material that was used. 3,720 is the one that was used. Remember, in the income statement, we need to record the total packaging material that was used, because the more when we use packaging, it becomes an expense. So now this is used, which is an expense one. In other words, in order for us to get to the 3,720, we need to say 4,700 minus what is left at the end of the year, so that we get to record this amount in the income statement. So this is the amount that will be recorded in the income statement under total as packaging material used. And I prefer the term that says used, because the used packaging material is an expense. So now that means we have to record a general journal. And please be mindful of the fact that packaging material used must decrease by 980. So let's record our general journal. We'll have to debit our packaging material on hand. Packaging material on hand. Material on hand. Remember, an inventory that is on hand is an asset. This is an asset inventory at the end of the year. Then now we have here packaging materials. Packaging materials. And our packaging materials, it is decreasing by 980. And I want to highlight this in brackets and say expense, so that we are very clear of what I am explaining. This is an expense. Now expenses decrease on which side? They decrease on the credit side. Remember, there's a line here. I hope I'm clear with my teaching. There's DR here, there is CR here. I don't normally do it in the general journal, because I know that the one that is indented inside, the one that is shifted inside, indicate a credit. So if I confuse you on that, apologies. But there is DR, there is CR. Now we have a credit of 980. The credit of 980 is an expense, packaging materials. That means our packaging materials is decreasing by 980. Remember, this is an item that will go to the statement of profit or loss. This will go to the statement of financial position. So now we need to record this in the statement of profit or loss, and we need to decrease our packaging materials. Let us go and record that in the statement of profit or loss. Under our packaging materials, there we do have packaging materials for an amount of 4.7 minus 980. So that our packaging material will be 3,720. That will be recorded in the income statement. Sometimes in the multiple choice questions, short questions and assignments, they will say how much packaging material will be recorded in the income statement. This is the one. We're referring to the total after the adjustments have been taken into account. That means now the entry on the credit side has been recorded. Please be mindful of that. I am looking at this individually. This is profit or loss. I have recorded this. The amount on the debit side is an asset, is the inventory that is left at the end of the year. So whatever inventory that we have at the end of the year is an asset. That is why we are recording the packaging materials on hand as an asset at the end of the year, inventory of the material of packaging that was not used. So this must be recorded in the statement of financial position where under inventory. So now we go to the statement of financial position under inventory. We say plus 980 rands, and this is done and dusted. Now we have recorded this entry. Both the debit and the credit side of this entry has been correctly recorded. Then we go to the next adjustment. Next one, it is 2.2. 2.2. Then now we go to the second adjustment, which is 2.2. 2.2 say that the long-term borrowing was entered on the 1st of October 2001. Which accounting period are we dealing with? We are dealing with the accounting period for the year end 31st December 2001. That means the amount of the loan, which is a long-term borrowing of 25,000, was taken in the current year on the 1st of October. So now we know that interest is paid every month. Let me go there to the adjustment. We borrowed this money 1st of October in the current year, meaning we should pay for October, pay for November, and pay for December. That means the interest on the loan is supposed to be for 3 months, October, November, December. Why October? Because it was borrowed beginning of the month of October. So that one is cool. Now it's further say that according to the agreement of the loan, interest is to be paid or payable biannually at a rate of 18% per annum. That means our interest is supposed to be 18% of the amount that we borrowed. And we borrowed an amount of 25,000 rands. There is the long-term borrowing. 25,000 rands is an amount. So now we're supposed to say 25,000 times by 18%. That means interest for the full year is supposed to be 4,500. But we only need to know how much interest were we supposed to pay for the period of only 3 months. Then it will be 4,500, multiply this by 3/12. Remember, in the income statement, we record expenses that were supposed to be paid. We were not supposed to pay interest for the full year, meaning from January, in other words. We're supposed to pay only for October, November, and December. And in December, it is the end of the accounting period. Remember, it doesn't mean next year we're not going to pay. I'm focusing only up until 31st of December, current year 2001. And now if we enter in the loan agreement, 1st October, it should be October, November, December. And we say the interest that you're supposed to pay up until end of the current year is only for 3 months. So now let us look at this amount times by 3/12. Now this is the amount that you're supposed to pay, 1,125. The question is, did we pay any part of this amount? The answer is no. Why I'm saying nothing was paid? Because in the trial balance, we don't have any amount that says interest on the loan. There is no amount that says interest on the loan. I've looked entirely in my trial balance. There is no amount that says interest on the loan. Remember now, why am I saying this? Because in the trial balance, meaning in the pre-adjustment trial balance, we record expenses that were paid. That means the advertising that we see here is the advertising that was already paid. The telephone that we see here is the telephone that was already paid. That means unless stated otherwise, all expenses that we see in the trial balance are the expenses that were already paid. So if an expense was not yet paid, it will not be in the trial balance unless the adjustment state otherwise. But most of the times, expenses that we see in the trial balance are the expenses that were already paid. So the minute we don't have an expense in the trial balance, meaning that expense was not yet paid. What does that mean? It means the amount of 1,125 was not yet paid, because if it was paid, it would have been recorded in the pre-adjustment trial balance. And the fact that it's not there, that means the amount of 1,125 of the interest on the loan was not yet paid. And we know that anything that is not paid and is supposed to be paid, we call it accrued expense. And we know that accrued expense is a liability, something that we're supposed to pay or something that we are liable to pay. So now we need to account and record the finance charges first. We need to record and say debit finance charges. In other words, we are acknowledging that we have an expense of 1,125 that we have incurred. That means we're supposed to pay, and anything that we're supposed to pay in terms of expenses supposed to go to our income statement. Then we say this expense was not paid, all of it. Then after we credit accrued finance charges. Remember, finance charges, it is interest expense. Even if you say interest expense, that will still be correct. Sorry for coughing. Now, we need to record this in the financial statements. And again, question number 1. Which financial statement is finance cost get to be recorded? It is the income statement, meaning it's under profit or loss. Is finance charge income or expense? It's an expense, and expenses increase on the debit side. And you can see this on the debit side. That means this will be recorded as a plus under finance charges. And the entry on the credit side is a liability. This is a liability. Accrued expense is a liability, and it will be recorded under payables. It will be recorded under payables, meaning under trade and other payables. So let us record the two entries, the one on the income statement and the one on the statement of financial position. Then we say, do we have any finance charges somewhere? Yes, finance charges 1,125, and it will be the only amount, to be honest, 1,125. There will be no adjustment to expect for this one. The other one goes to the statement of financial position under trade and other payables plus 1,125. Why? Because liabilities are increasing on the credit side, and this amount is on the credit side. And accrued expense, which in this case accrued finance charge being accrued expense increase is accrued expense is a liability, and liabilities increase on the credit side. So now, and I highlight this, make sure that you record the amount on the debit side in the correct financial statement, and also the amount on the credit side in the correct financial statement. The minute you do that, at the end of the last adjustment, you will be done with the financial statements and you can balance them after immediately. Then we go to 2.3. We look for adjustment 2.3. Adjustment 2.3 tells us that we have an amount of advertising, where it says to us that advertising include, take note, advertisements include include how much or include what? Include an amount of 400 paid forward for January. That means in the amount of advertising that was paid, remember I said expenses that are in the trial balance are expenses that are already paid. That means the 2,000 is already paid, and included in this 2,000 is an amount of 400, and the amount of 400 does not belong in the current year. It belongs in the month of January 2002. That means we paid something before time, and anything that is paid before time is called the prepaid expense, or any expense that is paid before time is called the prepaid expense. So this is prepaid expense, and prepaid expense is an asset, and assets increase on the debit side. That means now if assets increase on the debit side, that means the amount of the prepaid expense must be recorded on the debit side of the general journal. And the double entry will be advertising, because we have prepaid advertising. So now we have to say prepaid advertising. Prepaid advertising expense. Prepaid advertising expense. And it is an amount of 400. And we credit advertising. Why do we credit advertising? Because the amount of advertising that is in the pre-adjustment trial balance, it is more than it's supposed to be. That means our advertising must decrease by 400. And how to decrease advertising? You record it on the credit side. Why? Because advertising is an expense. So now expenses decrease on the credit side. Now I highlighted that the debit side is an asset, and it will be under trade and other receivable. Trade and other receivable. It will be under trade and other, meaning under our receivables, money that we can receive at any time. So this is an asset. We paid money before time. So now prepaid expense is an asset. The one on the credit side is an expense. We can see that. And now advertising expense is an expense, and expenses decrease on the credit side. And this will be in the statement of profit or loss. It will be decreasing that advertising. Now let's record this one on the debit side first. The debit side is an asset. It goes under trade receivables. We say under trade receivables, we say plus 400, because the prepaid expense is an asset. The amount of 400 of advertising belongs to the next accounting period. Advertising, where is advertising on the next page? Advertising, we say minus 400. Remember, the 400 is not an expense for the current year. That is why we remove it under advertising. 1,600. We are removing the 400 because the 400 of advertising is not for the current year, it's for next year. So we don't want this 400 to be in the income statement of the current year, because the income statement must reflect expenses of the current year, not expenses of the next year, because the 400 of the advertising is for next year, not for the current year. That is why now it becomes negative in the income statement, reducing our advertising, which is overstated by advertising of next year. Now, and again, this is negative, and this negative is reflected in the general journal on the credit side to show that expenses decrease on the credit side. So in the general journal, it's exactly the same thing that we do in the given financial statement. Now, please don't forget that there are what you call narrations. And I normally don't have time for narrations. A narration is just an explanation of what the adjustment is all about, where you just say advertising paid for January, or prepaid advertising of 400 for January. It's just a short narration that we normally write here in brackets, or just write the short line telling us what this adjustment is all about. And I must be honest, I'm not a narration person, but narration becomes very crucial in corporate, because in every adjustment that you record in corporate, there must be a narration. Now, we have captured the 400 in the statement of financial position and under trade receivables, and we have that 400 there recorded, and we have captured the one on the credit side under the income statement and as negative. then our advertising became an amount of 1,600 rands. 2.4. Then now we go to 2.4. 2.4 is another adjustment. So this one we are sorted out with it. If guys you need any clarity, please don't hesitate to contact me. You'll get my cell phone number in my website, and my website is www.unlockaccounting. Unlock Accounting, that is where you'll find many videos. unlockaccounting.co.za. That is where you'll find the rest of the videos that will unpack, that will unlock your knowledge of financial accounting. Now it's called unlockaccounting.co.za. Then now it says in 2.4 that rental income includes, and you see this word again, rental income includes. And I want to go back to what I said previously. Now I said again, the incomes, we have rent income. Do you see that? Rent income and interest on investment. The incomes that you see in the trial balance are the incomes already received. Let me repeat that. The incomes that we see in the pre-adjustment trial balance. Remember, this is the pre-adjustment trial balance, meaning before the adjustments were taken into account. The incomes you see in the pre-adjustment trial balance are the incomes already received, unless the adjustment state otherwise. But most of the times, income that you see in the trial balance is the income already received. But with exception with one income, the revenue income, the sales, because sometimes we can sell on credit. So that is the only income that is with exception of what I'm saying. But all other incomes, most of the times, more than 90% of the times that we see in the pre-adjustment trial balance are the incomes already received. So now that means we have received a rent income of how much? Of 15,600. Let us listen to the adjustment. That is what has been received already. They say rental income include an amount received in respect of January 2002. I want to put this part here. Rental income include an amount here in between here received. Say here received, just for more clarity. Include an amount received in respect of January. That means the rent that we have received here is not for 12 months. Now, in other words, the assumption is that we have entered in this rental agreement beginning or before the beginning of the current year. That means we're supposed to receive rent for 12 months, but we received rent for including January. So now if January is included, meaning January of next year, if January of next year is included in the amount we received, that means the amount that we received as 15,600, it is for 13 months. Then we need to say divide by 13 months so that we know how much is the rent per month. Are we clear with that? Now it says we received the rent including the rent for January next year. We don't need income for next year because income for next year will be acknowledged in the income statement of next year. That means our rental of 15.6 is overstated. We received more than we're supposed to have received. Then we need to say 15,600 divided by 13 so that we know how much is the rent per month. So now we can see that the rent per month is 1.2. That means the rent for the 13th month being January 2002 is 1.2. So now meaning 1,200 is what you call received in advance. Received in advance. That means it's what you call income received in advance, in other words. And income received in advance is a liability. Liability. Income received in advance is a liability. And liabilities, they increase on the credit side. That means we need to credit our income received in advance on the credit side. Now remember once again that income increase on which side? Income increase on the credit side. Now if we are saying that our rent of 15.6 is overstated, is more than it was supposed to be, that means we need to decrease our income by how much? By 1,200. We decrease it on the debit side so that it becomes 1,200 only for 12 months times by 12. That means this is the income that need to reflect in the income statement. So now that means we can go and record our adjustment. We already know that we will have, let me just start now with the financial statements. We said income received in advance is a liability, meaning that 1,200 will be recorded under liabilities and under our current liabilities because it's a short-term liability. It's only a liability up until the end of January next year. After end of January, the 1,200 which was received in advance will no longer be a liability because the month it was received in advance for has arrived. Now, this is the one that is on the credit side because it's under liabilities, and liabilities increase on the credit side. So now we go to the debit side of the general journal. The debit side, it is where we are saying now our incomes are overstated, meaning the 15,600 is overstated. We need to reduce it by 1,200 so that it becomes 14,400. This is the rent that we're supposed to receive, meaning in our income statement we only want to see incomes that we're supposed to have received during the accounting period. Anything that we are not supposed to receive during the accounting period, it will be now a liability that go to the statement of financial position. Now let's record the general journal. In this one I started with the recording, then ending with the general journal. Remember, we highlighted the fact that this 1,200 is a liability and is income received in advance, and liabilities, we said they increase on the credit side. And we said now because our rent income is overstated, we need to decrease our rent income by 1.2 and income decrease on the debit side. So we debit our rent income by 1.2 so that we're decreasing the amount that is in the total balance. We decrease our rent income by how much? 1,200 rands, and we credit rent received in advance. Rent received in advance. And our rent received in advance is 1,200. And now the one on the debit side, go to the statement of profit or loss. It will be decreasing the rent income. The one on the credit side, go to the statement of financial position. Statement of financial position. It will be increasing the liabilities. And our liabilities will be plus to our liabilities. And we did increase our liabilities by 1,200 rands. Now guys, when you do this, you are guaranteed 100% in this question. It's a guarantee. If you can master your adjustment, you are done. The rest becomes history. At the end of the last adjustment, you are done and dusted. You record. Then after you go and look for your allowance for credit losses, then you get out of the exam. You got 100% in the question. Now some of you will testify after May or June assessment and say thank you, this has been of good help. Now we go to the next adjustment. Next adjustment, it is adjustment number 2.5. Let us listen to what 2.5 has in store for us. 2.5 in store for us the interest on the fixed deposit. It says interest on a fixed deposit has not been received for the last 2 months. Before that, it says interest on the fixed deposit. Let us look for the interest on the fixed deposit. There is interest on the fixed deposit of how much? Of 5,000. Remember, this is what we have already received. I said incomes that we see in the pre-adjustmental balance are the incomes already received, meaning we have received 5,000 of interest income. Now we are told that the interest was not received for the last 2 months. Now, we are told that the interest rate in this investment is 12%. Even if they didn't tell us that is the last 2 months, we will still be able to calculate. Let me prove that to you. How? How much is our investment income? We do have our long-term investment, which is a fixed deposit of 50,000 rands. Now, if we say 50,000 rands times by 0.12, remember this is 12%. In other words, we are saying 50,000 rands times by 12 over 100. I want to make sure that is very clear. So the amount of rent that we supposed to receive for the full year, it is supposed to be how much? 6,000 rands. Let me show you something in the financial statements. What does this mean? It means the amount of rent, the amount of the income that is supposed to be under our total interest income. This is how much we're supposed to have, 6,000. But how much do we have? It's 5,000. That means this amount is short by how much? By 1,000. That means this is accrued income, income not yet received. We can see that this is accrued income, meaning income not yet received. We can see that is very clear. Now, they didn't have to tell us that it was for the last 2 months, then you must calculate 2 months. No, that was not. It was just more additional information. Now we have 6,000 for how much? For how long? For 12 months. If we need to know how much is the interest for 1 month, we divide by 12, we get 500. Then now we can say in the amount that we have, which is 5,000 that we received, divide by 500. We can say that 5,000 divide by 500. We can say that this is for 10 months, but that is another long way. They've already given us that is only for the 2 months, but that's how you can verify the 10 months. But we already know that the amount of 2 months, if the 6,000 is for 12 months and for 1 month is 500, then 2 months will be times by 2, meaning 1,000. So now we can say that 1,000 is the income that was not yet received, meaning accrued income. Now, in other words, now in closure to this question, in other words, the income that we see in the trial balance, this interest income is less than it was supposed to be because we have not received interest for November and December. So it becomes underestimated. It's not what we're supposed to have received. So now we call this accrued income, that 1,000. Income not yet received. And remember, accrued income is an asset. It's money that is supposed to be received but not yet received. So now we have to say debit accrued income. We debit accrued interest income, which is an asset. Accrued income is an asset, and this amount is an amount of 1,000 rands. Then we say now our interest income supposed to increase. Our interest income supposed to increase. Our interest income supposed to increase. This will be our interest income. 1,000 rands is the correct amount. In other words, we are saying the interest income supposed to increase by 1,000. Remember, interest income is recorded in the statement of profit or loss. Accrued income is an asset, and it's a current asset. It will be under receivables, under trade and other receivables. That will be under trade and other receivables. So the 1,000 rands will be under trade and other receivables plus here 1,000 rands. Then we say the one on the credit side must be increasing our income. There we do have, it's already a plus under our income. So guys, that is how it is. You could have said again 50,000 rands, 50,000 rands times by 12%. It gave you exactly the amount that we're supposed to have received. Remember, if in the adjustment, guys, they are just very, very silent. They don't give many details. That means they are telling us that in silence. They are telling us in silence that we have entered in this investment agreement before the beginning of the current year. That means we've been having the investment for the full year, in other words. Hence, they don't give us the same scenario where they said we entered in the loan agreement 1st October. They don't tell us the date we entered because they know that we entered before the beginning of the year. That means we're supposed to receive interest for the full year. So please be mindful of that. When they are quiet, then we assume that we're supposed to receive 12% out of the 50,000 for the full year. Then the difference between what was already received and what was supposed to be received will be an accrued or a prepaid, but in this case, it's an accrued expense. Sorry, an accrued income. Number 2.6 says insurance includes, again the word insurance includes. That means the insurance that is already paid. Once again, expenses that are in the pre-adjustmental balance are the expenses that are already paid. That means the 2,250 of the insurance is the amount that we have already paid. They say now, out of the amount that we already paid, there is money inside there. And the money that is inside there included is 750, which is paid for what? For the period starting November to October next year. Meaning it will be November this year, December this year, and January up until October. That means there is 10 months of next year that we paid this amount insurance for. They say insurance include an amount of 750 paid for the period from 1st November 2001 to October. That is the full year. That means we have a prepaid expense where we paid an amount for the next year. But the 750 is for November, December. Remember, November is 2001, December is 2001. So we only need to have paid only for 2 months. January, February up to October next year, it is prepaid. Now, meaning from January to October next year, it is prepaid. That will be our prepaid. We need to say now, in this insurance of 750, how much is it per month, first of all? Per month, it is 62 Rand 50 cents. And we are saying 2 months, we are fine with it. It belongs in the current year. And remember, this 125 is already inside the insurance account. Then we say the 2 months is fine. There's no problem with that. But out of the 750 divided by 12, there is 10 months, which is times by 12, which is January next year. Sorry. Out of the 750 divided by 12, which is 250 times by 10, there is 10 months of 625. So from January to October of next year, it is equal to 625. The 625 is a prepaid. The 625 is paid for January, February, March, up until October 2002. So now all those 10 months, of which the insurance for each of the month, it is equal to 62 Rand 50 cents. It is a prepaid expense. And the prepaid expense, please highlight that, prepaid expense is an asset. Prepaid expense is an asset. And assets increase on which side? On the debit side. So that means we need to say debit prepaid expense and we credit insurance because we need to reduce our insurance account by the amount that belongs next year. So now this is 2.6. We debit our prepaid insurance by an amount of 625. We credit our insurance. Why do we credit our insurance? Because we need to decrease our insurance account. In other words, we need to remove the amount of 625 in our insurance account because it is included there. And we don't need expenses for next year in the income statement of the current year. I want to remind you of that. We don't need expenses of next year in the income statement of the current year. That is why now we say under our insurance, we don't need to see the insurance that is paid for next year in the current year. So the 625, we don't need to see it in our income statement. But it is an asset. A prepaid expense is an asset and is under trade and other receivables. plus 625. I need to see this amount there. So now we proceed again in that same note. Proceed in that same note. Now 625 is trade and other receivables. Then we go now on the next adjustment. Remember, this is in the statement of financial position and under trade and other receivables. And this is statement of profit or loss. This will be minus under the expense, which is the insurance expense. So the 2.6 adjustment has been recorded correctly. Both the debit and the credit must be recorded in their respective financial statements, please. Then we have 2.7. 2.7, let us listen to what this adjustment has in store for us. 2.7 says that the telephone account of 165 for December has not yet been paid. Not yet been paid. Not yet. I want to highlight this. Not yet means accrued. The word accrued means not yet. And accrued, if it's an expense, becomes a liability. If it's an income, becomes an asset. In this case, it's an accrued expense because telephone in this case is an expense. So this becomes accrued expense. And accrued expense is a liability. And liability, they increase on the credit side. So that means we need to credit the accrued expense of 165. And what do we debit? We debit our telephone. Why would we debit our telephone? Because the amount of 625 was not yet paid. Now, if it was not yet paid, that means it is not in the trial balance, meaning it is not included in the amount of the telephone. It is not included here. That means the 165 is not included here. Why am I saying that? Because I said before that expenses that are in the trial balance are the expenses that are already paid. So if this is what is already paid and they say 165 is not paid, that means 165 is not included in this 1.4. That means we need to increase that 1.4 of the telephone expense because it is supposed to be there because this telephone is for the month of December. And December, which year? December 2001, which is the year that we are dealing with. That means our telephone is underestimated by 165. We need to say plus 165 under our telephone account because the amount of 165 is for the current month or is for the current income statement, which is the month of December 2001, which is the current year. And we do need this amount because it belongs in the income statement of the current year. And in the income statement, we record expenses for the current year, expenses that were supposed to be paid, not necessarily actually paid. And this was supposed to be paid. So now, because it was supposed to be paid, we must acknowledge it as an expense of the current year. The fact that it was not yet paid, then which is accrued expense, it then becomes a liability at the same time. We say we're supposed to pay this, then we acknowledge this as an expense of the current year, and we say because we have not paid for it, therefore now it's a liability at the same time, 165. It's an expense that we have incurred but not yet have paid for it, then it's a liability, meaning accrued expense. Let's do the general journal now of what I've already explained. We debit our telephone, and our telephone is 165 rand. We credit our accrued telephone. Credit accrued telephone of 165 rand. The entry on the debit side, go to the statement of profit and loss. This is the statement of financial position under trade and other payables, and it's a liability. This is an expense, and it's increasing expenses, and this is increasing the liabilities, plus to both of them. And we have done that our liabilities, they increase by 165, and also our expense, which is called telephone, is increasing by 165. So now we'll have 1,565 as a total of our telephone expense. 1,565 as our telephone. So we are done with that adjustment. Let's look at another adjustment. Let's look at another adjustment. The next adjustment, it is 2.8. We are closing this question. 2.8 says to us that equipment that costed us 2,000 was purchased on the 1st of July 2001. Remember, this transaction was recorded at the date of the transaction. If it wasn't recorded, they should have told us. So now the asset was bought, but why are they bringing this across? Because they want us to calculate depreciation on equipment, of which they said depreciation must be provided as follows. On equipment, 10% on the diminishing balance method. That means when it comes to all equipments, we need to know that the 2,000 cost or value of the equipment was bought in July. So depreciation must be multiplied by 6 over 12, meaning July, August, September, October, November, December. That is why they are only extracting this one equipment, which was bought during the year, not beginning of the accounting period. So now we go to so I'm highlighting this 2.8. Now we go to number 9, because 2.8 and 2.9, they go together. In other words, we are recording 2.9, which also is extracted from 2.8. Now it says depreciation must be provided as follows. We have depreciation for vehicles at 20% per annum on the diminishing balance method. Remember, the diminishing balance method says cost minus accumulated depreciation. Cost minus accumulated depreciation. So now we are calculating depreciation on vehicles. Remember, vehicles have been in the business for longer than we know. On vehicles, we need to look at the cost of the vehicles. And we say cost, sorry for that, of the vehicles amount to 40,000. Accumulated depreciation on vehicles, it is 11,200. So we say 40,000 minus 11,200. We get the depreciable amount. What is called depreciable amount? We say 40,000 minus 11,200. Then after we multiply by 20%, which is 0.2, then it will give us depreciation of 5,760. 5,760. I need to get the answer here. Times by 0.2, it was, okay, 40,000 minus 11,200, 28,800. This is 28,800 times by 20%, 5,760. So this is the depreciation on vehicles, 5,760. Let me just capture it there. 5,760 plus the second depreciation on equipment. Then let me, this one is much delaying. Let me use the different one, this page. Then we're calculating now depreciation on equipment. Depreciation on equipments. Let me start with the new equipment. The new equipment cost was 2,000, and at the time it was bought, it does not have accumulated depreciation. We multiply it by 10%. I think depreciation for equipment is 10%. On vehicles it was 20%. Yes, equipment is 10%, so 10% of that cost times by 10%. That means I can say 2,000 times 0.10, it gives me 200 times by 6 over 12, meaning I need depreciation only for 6 months, times by 6 over 12, it gives me 100 rand. Then I need the cost of the old equipment. The old equipments, they have a cost that include the 2000. They have a cost that include the 2000. That means the equipments of 9,000, they include the 2,000. So that means the old equipment cost is 7,000 minus the accumulated depreciation. Remember, this accumulated depreciation is at the beginning of the year before the new equipment was bought. So the depreciation for the new equipment is not there. Minus 1710. Minus 1710 equals, we have 7,000 minus 1710, we get to 5,290 times by 10% times by 0.10, this gives us 510.29. Then our depreciation plus 100, it is 629. So depreciation on equipment is 629. Then we go and we add our depreciation on equipment under our equipment depreciation. So under our depreciation plus 629. So this gave us the total depreciation, 629 plus 5,760. It is 6,389. So this will be our depreciation for all the assets. Now the depreciation must be again deducted. 5,670 minus 629. We have to say here minus 5,670 minus 629. Now we are deducting all the depreciations from the cost of the assets so that we get into the carrying value of our property, plant and equipment. Please don't forget to record the depreciations here. Now how do we account for this in the general journal? Very easy stuff. 2.9/8, but it's 9. We debit our depreciation. We credit our accumulated depreciation. Specifically on vehicles, 5,670, and accumulated depreciation specifically on equipment, 629, and this is 6,389. The 6,389 is the total of the depreciation. Now again the question is, how much depreciation will be recorded in the income statement? This is the depreciation that will go to the income statement as one amount, but specifically for vehicles is this amount. Specifically depreciation that goes to the income statement for equipment is 629. So this is how we account for this. Remember, this is the profit and loss statement. This go to the statement of financial position. Statement of financial position. And this will be reducing the assets, increasing the expenses, this one. So we have accounted also for that. Now this is just in summary now. In summary, closing everything. 2.10 and only one adjustment is left. 2.10, only one adjustment is left. The account of loss ends Ltd. A debtor who owes the entity 200 must be written off as irrecoverable. This is a bad debt. The customer who does not pay his account and has been declared insolvent and is irrecoverable, meaning there's no way we can recover this amount. It's been declared by the court of law as insolvent. Then we debit our bad debt, which is question adjustment 2.10. We debit our credit loss. Remember, the word credit loss and bad debts is the same. So either we say credit loss or bad debts, it doesn't matter. Credit losses or credit loss, and even if you see there, they just to verify, they do specify credit loss, but they don't, or the account of loss and shows account of return off and return off. Okay, they don't specify, but still a credit loss and bad debt, the same thing. Credit losses or bad debts is an amount of 200. Now this customer will no longer pay. This is an expense, and expense go to the income statement, increasing expenses on the debit side. Then we credit our debtors. That means this account must be reduced. This debtor will no longer pay. Therefore now our debtors will decrease by the amount of 200. That means under our trade and other receivables, the amount of 200 will never to be received. Then we say minus 200. It doesn't matter where you write. I just have limited space. I don't want to write 200 here because I won't have space to write the total amount. So hence I write it there on top. But I know in your books you'll always have space. Minus 200 rands. Then I will say this is the amount that go to the income statement, and under our credit losses there should be credit losses somewhere. Credit loss of bad debts. Credit loss, yes, there plus 200 rands. So this will be 750 rands, the total of our credit loss. So there's still one amount to be accounted for, that I know. So we have recorded this adjustment and it's covered in all angles. There we are. Then we have covered this. We go to 2.11, the last one, the allowance for credit losses. It says it was determined that on 31st December 2001, the allowance for credit losses should be maintained to 250. It was determined that on 31st December 2001, the allowance for credit losses should amount to 250. So our allowance has been accurately adjusted end of the year to 250. In the trial balance, we already had an allowance, and the allowance in the pre-adjustment trial balance was an amount of 300 rands, and it decreased now from 300 to 250. Therefore, now that means we overstated the estimate of the credit losses. Remember, the allowance for credit losses is an estimate that debtors that are worth 300 will not pay us. And this was acknowledged already. So now, if it decreases, then we need to say 50 rand must be deducting our expenses, meaning our credit losses in this case will have to decrease by 50 rand because we have overstated the estimate of our credit losses. So the 50 rand goes to the credit losses in the income statement, and it will be minus 50 rand. And most of the times we can say minus 3, we can say minus, if we have recorded the one in the trial balance, we could have said minus 300 plus 250, like that. Then we know that yes, minus 300 plus 250. In other words, the net of this will be minus 50 rand. So we are minusing the 50 rand. Where now our credit losses have been overstated, which is 300 minus 250. I'm just looking at the sign now as I'm writing. So the net of the 300 minus 250 will give us the 50 rand. Now the reason why credit losses are decreasing is because the provision for credit losses at the end of the year has decreased. If this was the other way around, I want to highlight that if our allowance for credit losses at the end of the year were 350, this will have to be recorded as plus 250. This was going to be plus 50 rand if it was an increase from 300 to 350. Then we'll only record the increased portion of 50 rand. But in this case, our credit losses estimate decreased by 50 rand. Therefore, now we also decrease our credit losses by the decrease in the estimate. But the amount of the allowance for credit losses of 250, we always reduce our credit losses by the amount of the allowance at the end of the year minus 250. Why so? Because we are estimating that our credit losses that we have sold inventory worth 250 to them, they will not pay us. So in other words, we are saying these people will not pay us. Therefore, now we remove them from the books and we say you are no longer debtors to us, because we are assuming that this amount will be a bad debt. But it's not specific to one account of the debtor, it's to all the accounts of the debtors. Therefore, now that 250 will be reducing our debtors, because we assume that debtors worth 250 of sales will not pay us. That's why we minus that. But we compare it with the previous year in the income statement and we record the difference. If it's an increase in the allowance from the pre-adjustment to the adjustment, if it's an increase, we add. If it's a minus, we deduct under our bad debts or credit loss in the income statement. Now, I think that was the last adjustment that we have accounted for. So because the last adjustment, that means we are honestly done with the income statement. That means we have covered the adjustments, covered this question, and this question, all the three financial statements. Now that we have covered all these three financial statements and we have done all the adjustments, we don't have to wonder now. The only thing that we do is just to record the totals. We have our sales, which are 380,210, cost of sales 164,750. We're just adding now. We have 14,400. When it comes to credit loss recovered, there was no other adjustment. Wages, they remain the same amount, 2,000. So where there's no adjustment, you just keep the amount as it is. 25,000 as our salaries. Rates, there was no adjustments regarding rates, 1.5. Licenses, 1,000. Vehicle expense, 3,500. There was no change. This 2,000 very squeezed. And the next one, credit losses, just calculating that amount. Credit losses, it is credit losses 550 plus 3,500 minus 50, that will be 550 plus 200 minus 50 rand. It is 700. Don't know where 3.5 coming from. Material packages, we accounted for that. Insurance 2,250 minus 625, 1625. 1625. Then the next one is 2,100. There was no adjustment regarding this. So your income statement is done. Finance charges, they are done. But make sure that when you draw the line, we don't include finance charges in this box. They must be outside this box. And remember, this box continues on this next page where we're calculating all the expenses. Then it will meet with the one on the previous page. And our total expense without recalculation, it is 50,699. Then we will have our incomes here. our income separately. Total incomes 20,520. 20,520. Gross profit to 15,460. I don't want to spend much time doing the verification of the numbers. I know that I've done my work very well. The other comprehensive, it is the revaluation surplus when the property gains value. Then the profit for the year, it is 184,156. Remember, this will be calculated by saying gross profit plus incomes minus expenses, and don't forget minus finance costs, because finance costs would not have been included in the expenses. The 184,150 goes here exactly. 184,150, 184,156, not 150, 184,156, 184,156. Then we get to the profit for the statement of changes in equity closing balance, 325,156. We take this as it is, goes to the statement of financial position. Under equity, under capital, there we have this amount as it is, 325,856, 325 or 156, 325,156, 325,156 or 325,856. Oh no, why I'm writing, can see that I'm tired. 325,856. Please do verify that the numbers, I know that they are correct. Then now we are done with this, and we have the total for the property, plant and equipment. And our total property, plant and equipment, we say cost and cost and cost minus 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 minus. If you deduct those, you'll get property, plant and equipment as 292,941. Fixed deposit still remains 50,000 rands. There was no withdrawal of the deposit or additional amount to be invested. Then under our non-current assets, we have 342,941. This is drawn there. The 292 is here under property straight. 292,941. You add those inventory 8.5, it will give us 9,480, and our trade receivables total will be different than the memo says, because I did a little bit different. It will be 5,750 plus 1025, which will be 6,775. Bank will be 3,700 plus 3.7 plus 9,480, 19,955. 19,955. And again, don't forget to draw the line there. Then that will be our current assets plus our non-current assets, 342,941 equals 362,896. It gives us 362,896. Then our non-current liabilities, 25,000. Then we have our current liabilities, of which our current liabilities is the sum of all these, which is 10,840 plus 1,200, 12,040, 12,040 plus 25,000 plus 325,856. We get total equity and liability at 362,896. This will be total equity and liabilities. Now this will be your statement of financial position, statement of changes in equity, and the statement of comprehensive income, and how to tackle it in the exam. I was explaining, took 1 hour 36 minutes. Yeah guys, if you use this strategy, it's very important first to master your elements of the financial statements. Know your income, know your expense, you know your liabilities, your capital, your drawings. The minute you know those assets, liabilities, and you know which side do they increase, more especially guys, the accruals. The accruals becomes very important. What am I referring to the accruals? The income received in advance, the accrued income, the accrued expense, the prepaid expense. Those four, they become key. There is a short video that will come also after this, where I will be explaining now the accruals, and the title of that video will say accruals, and I'll be giving you 4 scenarios trying to explain the accrual that I've already done here, the income received in advance, and also linking that with the trial balance at the same time. Now please be on the lookout for that video, but I'll also be sharing it to you immediately when I'm done with the recording. And with the closure, don't forget to visit me at unlockaccounting.co.za. You subscribe to any subject at a once-off payment of 450. You get a whole lot of videos only at a small price of 450 for a period of 6 months. It's a once-off. You pay once off 450 for 6 months. Then you watch all the videos. If you need me to add more videos, you have past question papers, some material that you have, or specific topics, you can request, then I will record that video and make it available so that you go and nail the exam. This will be unlocking your life of accounting. Thank you guys. God be with you.